the gain piece and not the entire proceeds. So 1031s, however, require you to reinvest the entire proceeds. So, you know, let's say that you had a 500, you had a sale and the proceeds were 500,000, and the gain on that 500,000 was only 100,000. The opportunity zone, you only need to reinvest that 100,000, and that 400,000 of principal, you can do whatever you want with it. So there's nothing that you need to do from that standpoint related to the reinvestment requirements. With a 1031 exchange, that whole 500,000 in my example would need to be reinvested into real estate. And I guess that's the other, you know, key differential here that we're going to talk about on the second bullet point is there's no restriction on the type of gain that's eligible for the deferment. Again, with the 1031 exchanges before tax reform, the Tax Cuts and Jobs Act in 2017, personal property like equipment and, you know, boats and airplanes you could do 1031 exchanges with, but now that's been narrowed to just real estate. And so that's a big difference that was part of tax reform and one of the revenue raisers to offset you know, some of the other tax savings that were part of that package. And the other thing too that's not on this slide, but the other big thing, at least when I think about it, is there's no qualified intermediary when you do the opportunity zone reinvestment. You just have that self-certification, that self-reporting. When you do a 1031 exchange or a like-kind exchange, you have to get a third party involved. It's the intermediary that handles the money and does reinvestment. So it's a little bit more complicated as it relates to that. Next slide, please. Capital gain, the capital gains rate is when it's recognized, not when it's deferred. I think we talked about that earlier. If the taxpayer dies, the gain is still recognized on the original investment, no step up on death as it relates to the opportunity zone. We've seen this a lot with real estate deals, combining an opportunity zone with other federal tax credits like new market tax credit, historic tax credit, low income housing. So when you start bundling this with other, you know, real estate incentives out there, it can be, you know, it can definitely add a lot of value. We're seeing a lot of deals put together with a number of those collectively that you know, really makes a lot of sense financially. Then when you start layering all that in. Going to talk a little bit about this combined with other state credits and incentive programs. So there's state incentives. States have already conformed to the benefits. Others are coming up with specific benefits. And then the other point here is, and we get this all the time, I think people naturally love to hear how they can save taxes, defer taxes, and, you know, pay the least amount as possible. I think sometimes what gets lost in these deals are you want to make sure that the deal's a good deal. You know, and obviously the tax benefits are great and can be a big part of it, but you just want to make sure that it's the right deal, that, you know, if the holding period, going back to some of the things we talked about, if it's a long-term, short-term investment, just factoring in those sort of things. Within Ohio, there's a credit that's equal to 10% of the taxpayer's investment up to $10 million investment. So Ohio, there's credits available that can actually be pretty meaningful. In order to get it, it's got to be 100% investment in an Ohio qualified opportunity zone. There was an application process that opened up on January 1st of this year. It was first come, first serve. We've had many of our clients apply for and get those credits. And the one thing to note here is those credits are transferable. And I've actually already dealt with a number of clients on this front, buying and selling these credits. You know, I don't think there's an open market per se, but just getting connected with those that have these credits. And so from that standpoint, one thing to note is, and we learned this from the Ohio Department of Taxation, that the credit should be claimed in 2019 or 2020, and it will not be transferable or saleable after 2020. The credit itself carries forward for 5 years, so taxpayers have to use it within 5 years. And so we have a number of clients where we don't think they're going to need this credit or be able to use it within 5 years. So at this point, we're saying, hey, look, you know, if we find someone between now and the end of the year, you can actually transfer this or sell it to them, get some value out of that credit. And we're seeing, again, there's no market, but we're seeing folks buying and selling these credits for, call between, I don't know, 75 and 85 cents on the dollar. So again, just some way to unlock some additional value if your clients can't use those credits, but that's something that you ought to evaluate if they're in these deals and have those credits currently.
Right, I think this is our last slide, and we're up against the time. So the only item I will mention from this slide that may be relevant for your purposes when you're consulting with your clients is that because of the COVID-19 pandemic, the IRS came out and basically extended the timing of that 180-day reinvestment period. And so if you have any clients that had capital gains that were generated and that 180-day reinvestment period was going to expire anytime between April and end of this year, they're automatically given an extension to invest that capital gain into the funds until the end of the year. So with that, we will conclude our presentation. We'd be happy to answer any questions, or if you guys want to reach out to us outside of the presentation, feel free to send us an email. We'd be happy to connect.